From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny. Welcome to the show. To underwhelm means you get a big penalty in the box. Airbnb, the bookings are down at the lowest place since 2020. Will the summer peak drive higher? The stock is 8% lower, dragging a little bit on SPOOs. We've had a whip around in the jobless numbers. We'll count you down to the open and what it means in the data. Good morning. Coming up at the show, those initial jobless claims coming in hotter than expected, sending futures and treasuries off their lows, injecting fresh life to the rate cut debate. We begin with a big issue, looking for the next catalyst.
There's been a cocktail of bullish catalysts here recently. Getting to earnings season, buybacks, blackouts came off, and there was just a lot of, just temporary tailwinds here for equities that kind of propped us up. But I think we're facing some resistance here around some moving averages, and once the market comes to grips that the Fed is not ready to hike, especially not ready to ease, especially as we see CPI next week, which is expected to be fairly hot. I think we'll probably retrace a little bit to the downside.
Cocktail of bullish catalysts are set to fade. Are they? Katy Kaminski of AlphaSimplex and Collin Martin of Schwab are with me to debate that narrative. Katy, good morning. Are the bullish catalysts set to fade, and have equities yet to meet their reality check? Good morning.
Good morning. Yes. I think, sorry, I didn't understand that you were asking that question. But what we're seeing right now is a very bimodal positioning across different asset classes. You're seeing that equity signals are still holding ground. But if you look cross asset, fixed income signals continue to be short, and you're seeing some steepening in the yield curve. And you've also seen a tremendous rally in commodities in the recent months, something like oil prices. You've even seen food prices start to pivot recently as well in terms of the raw products like wheat, corn, soy. So you're seeing two different narratives, one that's saying sticky, higher for longer inflation, and then the equity markets trying to digest how serious is this for us. So hence the CPI is going to be really important next week.
Yeah, I think the debate on just how hot that is something we're going to work out. Collin, good morning to you. Bonds have had a recalibration, a little bit of a pip higher and a turnaround on these jobless numbers. But when you look at the bond market, do you think that momentum is running out of breath on the recalibration of a drop in yield?
I think it is. We think yields will probably remain range bound for a little bit until we get more evidence that the disinflationary trend will continue. We are seeing plenty of signals in other sorts of data that support the view that inflation should slow from here. But I think until we get more evidence in the actual numbers, so like next week CPI in the PCE numbers, and not just next week, but over the next month or two or three. I think until then, and until we get evidence that cuts are coming soon, we might see yields trade in this range. We think over time they should move lower, but until we get that disinflationary catalyst, they might remain range bound.
Yep, all eyes down for next week. It's going to be fairly definitive on additional information on the inflation front. We've just had some data this morning. Let's catch up with Mike McKee. He's side by side with me here. So the jobless claims 231, Mike. We're going into a 30-year government auction, and not to be outdone, you've got a little bit more data coming tomorrow. Good morning.
Good morning. Well, there is a lot of concern about whether the U.S. economy is slowing or not, and the jobless claims would seem to suggest that. You look at the initial claims, 231, as you mentioned, running well above the year-to-date average last week. Continuing claims are just about at the year-to-date average. They were up as well. Is this a sign that the economy is slowing, the labor market is loosening, and we might face recession down the road? No. And here's why. You take a look at what's been happening with jobless claims, and you go into the history of it. And it's a little hard to read on this because obviously 2020 skewed everything. But you can see the green line is the average of jobless claims over about 50 years. And yes, jobless claims rise when you go into recessions. And we're not rising right now. We've gone up just a little bit, but you can see how far that white line is below the average still, even at 231. So what happened? New York school kids went on vacation the last 10 days of the month of April. So the first week in May, which is what the numbers are counting today, show that all the people who are eligible in the school system to file for unemployment did so. Expect a drop back next week. What does it mean for the Fed? Well, nothing there, but their attitude is pretty much all the same. Everyone's singing from the same songbook, including Susan Collins from Boston yesterday, saying the recent data lead me to believe this will take more time than previously thought. That is probably the case, so we kind of put that aside, except for the fact that the Fed on hold is a problem for the rest of the world. And I go back to the old saying about it's our dollar, it's your problem. And it is a problem for everybody else. You can see I normalized the changes here. Currencies, the pound, the euro, and the yen inverted there, have been dropping because the Fed's been raising rates, and you get more money and more interest in the United States than other places. We saw that today. Bank of England on hold, but everybody thinks they might cut, so the pound goes down. And at this point, this is a problem for those countries, but it also starts to be a problem for us. If we continue to have problems selling exports overseas, it's going to hurt the manufacturing numbers that we might have seen a little bit of in the ISM last week.
Nobody wants to challenge that strong dollar policy, do they, Mike? Let's see until it bites in the proverbial. Now, you mentioned the Bank of England, Mike, so it's worth just checking in some of those cross assets this morning. You've got sterling back to flat 124.95. The Bank of England Governor Bailey, who we'll sit down with a little bit later on, he's optimistic that things are moving in the right direction. A rate cut in June is neither ruled or planned. And there was a bit of a shift. The Deputy Governor inside the Bank of England moves and joins the external member, calling for an immediate cut. So the narrative is building on that. Euro slightly better bid against sterling, and 10-year yields flat at the moment, but a great deal of the dovishness was already in the price. Katy Kaminski and Collin Martin are my guests this morning. To the global aspect of this, there's the Bank of England sounding more dovish. The Riksbank cut. The ECB are presumed to cut earlier. We are moving towards a global rate resetting narrative, Katy. How important is that for overall growth momentum to sustain? Because it does all feed back and wash back into the US at some stage.
Yes, and I mean, I think it's important you bring this up. And if you look at those economies that have already started to push more towards cuts, they're seeing less growth than what we're seeing in the US. And that's why there's definitely a much more tricky picture, and it might take a little bit longer for the US to be able to cut rates. The market wants it. I think the Fed wants it. But in general, the data hasn't shown yet. We also point out, if you look at countries like the UK and Sweden, example, they have a lot of floating rate mortgages. So they have definitely seen a bigger impact in their housing sector than we have seen in the US. So I think there's just differences across these countries where, in terms of how quickly they're going to be able to normalize rates.
Look, absolutely. And the argument is here in the United States, everybody, not everybody, but a great many people went through the remortgaging process at those lower rates. Collin, you know, the Fed could be the last central bank standing, the last hawk standing. And that has got consequences on differential trades, on Treasury bonds, on Treasury against other government bonds, and also for the dollar as well.
Yeah, that's right. If we look at the global bond landscape, the gap between U.S. yields and global bond yields has rewidened recently, and I think that's one thing that could keep a lid on our yields should we get some upside economic surprises where there might be some foreign buying, especially if we get closer to those 5% levels on intermediate and long-term bonds. I think that's a psychological level that a lot of investors are interested in. So I think that's important. Going back to your comments about the dollar has been strong. We saw it drop a little bit this morning with the initial jobless claims number, but there can be benefits to that in terms of inflation, where it does negatively impact exports, but it can positively impact imports. And we know that we're trying to bring inflation down, and the stronger dollar can help that to a degree in terms of import prices.
Collin, just before we move on, what is it that retests 5% in the 10-year government bond yields? Because we've had, as I say, this recalibration. It's my favorite word at the moment. But what is it that spooks me back to 5% on 10s?
Well, I want to make it clear, it doesn't spook us. We don't think it's happening. But what could happen if the economy were to not just remain as resilient as it is, but really reaccelerate, and then we'd likely need to see a reacceleration in inflation, even just modestly, which would reprice expectations for the Fed to not just be a higher for longer policy, but actually start to see more rate hikes coming down the pipeline. Doesn't seem likely right now. Most Fed officials, with the exception of one or two, have generally pushed back against that. Markets don't really believe that. So as long as the next move is expected to be a cut, we don't really see long-term yields really getting back to that 5% area.
And Katy, for you, I mean, as Collin says, look, that's not his base case scenario. When you take the narrative, it is that they want to cut. They just want more time to understand, to recalibrate, to be cautious, to let it be bumpy. As you look at the equity market landscape, we've had a lovely run. We've had this slight pause. So what is it that would get you to deploy more into equity before rate cuts?
Oh, that's a really good question, because frankly, we've seen such a big move that we need to kind of see resilience. We need to see that we can waver through this. So we need to see good earnings. We also need to see relatively resilient labor data. We need to see that things are still sort of safe and we have a way to navigate through higher for longer, such that we're not seeing deteriorating financial conditions. Right now, it's still looking relatively bullish on equities, but whether or not you're thinking about entering, it's got to be something to make you pause, given exactly what Collin said. I mean, just thinking about the fact that you could start to see a steepening in the yield curve. We have seen a little bit of that recently. And so I think that has made people a little concerned that, this inflation narrative could be even stickier than they would like. And thus, it's harder to navigate for equities, making that more questionable.
And yet, without sort of putting you into the box of talking about specifics, I look at overnight what has happened with Airbnb. That's consumer. Uber, that's also pressure. Disney, subscriber numbers, parks were resilient. But at Starbucks, at McDonald's, there are, if you underwhelm, if you underperform, if you underdeliver, you really are getting a pretty big pressure pushback from the market, aren't you, Katy?
Yes, I would agree. I mean, if the consumer starts to waver even more, that would definitely be something to be concerned about. That would eventually trickle into growth and will affect company earnings. And then you'll also see more sort of ammunition for the Fed to actually act. So I guess that would be something that might be pro rate cuts sooner. So I think it's bad news is good news on the consumer side, but hopefully we don't have that.
We're always trying to sort of find out where the next risk is, whether it's systemic or idiosyncratic. I'm just wondering, we wrote the big take, not me, but the team here at Bloomberg, and it was about the phantom debt, the buy now, pay later. And anybody who's lived through 2008 on the mortgage crisis, anybody who's lived through 2000 in terms of the dot-com bust. Collin, what did you make of the buy now, pay later? I mean, the Fed doesn't seem to be too worried about private credit and those kind of areas, but buy now, pay later, some of the numbers are quite chunky.
Yeah, I saw that article yesterday. And what I guess makes me a little bit nervous is that we don't have a full picture of what's going on underneath the surface. So if it is, in fact, a really large amount of debt that's out there that we're not seeing in terms of what consumer credit looks like, then that would be a risk. What I think is a good thing, if we look at the data that is available, we did get consumer credit earlier this week, and it rose at a pretty small amount, especially with credit cards and that type of revolving debt. And I think that's a good thing, because if we look at what's been powering the economy lately, the consumer remains strong, consumption remains strong. But if we do see a slowdown in credit growth, I think that's a good thing and more good news for a potential soft landing.
I think the number here, I've just opened the story, $700 billion globally by 2028. And that's all grand if you're in a job and you're earning a solid level of remuneration. And of course, on a repurposed mortgage at about 2%. Life is sweet. Katy, thank you very much. Katy Kaminski and Collin Martin, my guests this morning on The Market. Let's look under the hood ahead of the opening bell. Abigail Doolittle is with me side by side.
And let's have a look at that one stock that you were mentioning. Well, several stocks you were mentioning, but one of them being Airbnb. Shares down sharply, heading to the worst day in more than a year. This, of course, after the guide was underwhelming for a second quarter in a row. Weaker demand as revenge travel fades. They are projecting the slowest growth since late 2020. As for some other movers on earnings, ARM, the chip holding company, beat, but the guide was viewed as a little light. Folks wanted a bigger boost given the AI component. Also fears that maybe there's some sort of an AI slowdown on this. The stock down 6%, but it should be noted up 40% into this report on the year. Roblox plunging, a record decline, heading to a record decline, down 25% in the pre-market. The online games and entertainment company is plunging on their weak second quarter outlook. But there is one winner here, and that is Bumble, up 12%, a huge first quarter beat. They also reaffirmed the full year guide. Now, the stock into this report, Manus, down 30% on the year. There is also a 13% short interest. So I think that some of this move higher for Bumble in the pre-market and perhaps on the open has to do with the short squeeze.
Okay, nothing to do with love lives eternal. Abby, thank you very much. Abigail Doolittle there with the very latest on stocks. Coming up, President Biden, he warns on Israel.
I've made it clear to Bibi and the War Cabinet, they're not going to get our support if, in fact, they go in these population centers.
Our conversation still ahead on Bloomberg.
They go into Rafah. I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks. But I've made it clear to Bibi and the War Cabinet, they're not going to get our support if, in fact, they go in these population centers.
A stern warning from President Biden to Israel. The remarks came as the U.S. paused the delivery of over 3,000 bombs to Israel. The White House is concerned over the damage that they would do to the city of Rafah. Israel's finance minister responding to Biden saying, quote, "We simply have no choice as this war is an existential one, and anything other than complete victory will put the existence of the Jewish state in danger." Amory Hordairn joins me now from Washington. Amory, I look at this statement from the Israeli side. I look at the Defense Secretary, Lloyd Austin, saying at Congress testimony yesterday, there have been too many casualties in this battle space. Here we are with an escalation from rhetoric and pulling back on some bombs that the United States were going to deliver yesterday. So this is a shift, the gravity of the shift from the White House. Good morning.
Good morning, Manus. And I spoke to Ed Mills earlier this morning from Raymond James, and he was talking about the fact that this is as close to a red line as Biden has been. One of his most vocal warnings on Israel in this interview yesterday evening. When we were talking about this yesterday, we really were talking about a pause and that no decision had been made at the White House. But then following this interview, it does look like that pause is almost definitive when it comes to whether or not these bombs would be going to Israel. Biden has been concerned, and he talked about this, about the civilians that have been killed, Palestinian civilians that have been killed in Gaza. And what is so concerning to the administration, of course, is how densely packed Rafah is with more than 1 million Palestinians there. There's also, of course, which we talked to Ed Mills about as well this morning, and he pointed to the fact that we are 6 months out from the U.S. presidential election in November, and there's been a tremendous amount of domestic political pressure, especially from the youth. We've seen this across the country at college campuses, on this administration to take more of a defiant tone when it comes to the Netanyahu government. We should also note, Manus, that yes, this is potentially a fracture in the relationship, but we have been here before in the past. There is historical context for this. It is rare to see this kind of break, but it's not unprecedented. We saw it with Obama, we saw it with Reagan, with Nixon, with H.W. Bush, and that is where this relationship is right now. But Biden, this warning was very clear yesterday. Israel will not be getting those bombs.
How much of this pressure, Anne-Marie, is because of the college campuses? You go back to the apartheid era, which is where that level of social unrest in youth protests against apartheid was brought to bear by divesting from South Africa. Many people are drawing comparisons with that for Biden. He's under pressure. We're running up to this election. The youth are important. To what extent is the domestic imagery pressuring Biden to exert more force on Bibi?
Well, I think there's just really a divide with some members of the Democratic Party, especially when you look at the progressive left. A lot of that is the youth vote, but also even outside the youth vote, even some concerns with Democratic senators, as well as clearly with a lot of some congressmen and women on the Democratic side that want to see more restraint when it comes to Netanyahu and how they are going after Hamas in Gaza. So there's been a lot of political pressure within Biden's own party, which is why this has been so challenging. Because in that same interview, he talked about how it is important to secure Israel, how it's important to make sure that they have the Iron Dome. He's talked about his ironclad support to Israel, but at the same time, he's also talking about not sending them some of the ammunition that the Israelis say they would need. And we haven't heard from Netanyahu directly, but I think members of the war cabinet have made very clear their displeasure with this. This is the tricky line Biden is walking, and until this is resolved in Gaza, this is going to be the tricky line Biden will be walking until November, Manus.
Indeed. Anne-Marie, how would you describe the nuances? There's been daily, sometimes over a series of weeks, conversations between Bibi and Biden. A lot of people question the ability of this administration to exert real force. They say if somebody else was in the White House, it may be a different scenario. Does that narrative hold? And to what extent is America still got the ear of Netanyahu? Or is that power and that influence seriously waning? And that's what's being said internationally rather than domestically.
I think what you see is that there's been a growing divide, especially since October 7th, when we saw this terrorist attack by Hamas in Israel. Biden flew to Israel, embraced Netanyahu. They were talking almost daily, then weekly. And now those conversations, even though there recently was one between Netanyahu and Biden, those conversations have become a little bit more sparse. What we do see, though, is that Bill Burns, the head of the CIA, is still in the region. And something the U.S. is trying to exert and trying to potentially even maybe use what's happening with this weapons suspension is they would like to see a ceasefire negotiation come to fruition. And at the moment, they are still committed to that when you have the head of the CIA remaining in the region to try to work this out. He met with Netanyahu, Ron Dermer, and other Israeli officials yesterday, and I believe today he'll be in Cairo to continue those negotiations. OK, Anne-Marie, let's see where this story evolves to. Anne-Marie Hordern in Washington. Coming up, your morning calls, and a little bit later, Jay Pelosky of TPW Advisory joins me after the opening bell. Let's get you up to speed with your morning calls from Wall Street. First up, Deutsche Bank lowers the price targets on Electronic Arts to $150. The firm keeps a hold rating on EA, saying that the company's multi-year guidance shows margin potential. Next up, Accountability Research raises the recommendation on Shopify to a hold. The online retailer yesterday reporting earnings that topped estimates. And finally, Raymond James upgrading Cheesecake Factory to outperform, saying the results were strong despite the softening trends in the industry. Nothing beats a chunk of cheesecake. We're going to catch up with TPW's Jay Pelosky. That's next after the opening bell. An hour since we had the jobless claims, and we've trimmed our losses as that number pops a little bit higher. We can argue as to whether it was idiosyncratic and to do with the holidays and people claiming jobless claims. Right now, we're back to flat. 52.12 is where we stand. And on the NASDAQ, keep an eye on Airbnb. It's been a real drag on this market, but we'll take you through that story in just a moment. In terms of the rest of the markets, cable is back to flat as we see a dovish tilt really from the Bank of England as the Deputy Governor goes on site calling for a cut. How much of that was already in
in the price. The dollar still remains fairly resilient. 10-year yields virtually unchanged, 450. We've got a 30-year government bond auction coming down the pike today, $25 billion worth of an auction. And there was a tepid demand for 10s yesterday. 2.49 was the bid to cover ratio. Crude ticks up by 0.25%. So some stocks that we're keeping a close eye on. Beyond Meat, despite the price hikes, the plant-based company, margins came under pressure from higher manufacturing and material costs. A classic story. Abby has the detail.
And on this, we have investors pretty rattled. The stock down 9% in the pre-market, down 14% at that point, the worst day in about a year. So investors not liking this report where they essentially missed estimates for the first quarter, EBITDA coming in a little bit light. On the other hand, what's interesting here is that they did actually maintain the full year guide. So there's a greater than 30% bearish short interest on this stock, suggesting that maybe some of those bears taking the idea from some of the analysts that it's not clear what's ahead. In fact, we have William Blair saying that they cut their 2024 EBITDA estimates to reflect that softer gross margin you were talking about, and that it's uncertain where this is going to lead them over time. But again, Manus, they did actually maintain the full year guide. And some analysts, other analysts, including Jen Bartashas here at Bloomberg Intelligence, saying that the resets in various geographies and culling of different products may actually be an encouraging sign. So it seems as though there is a bull-bear debate on this stock, but right now the bears have it down 12%. Again, I would note that there's a massive bearish short interest on this stock. Probably a lot of this, those bears pouncing.
Abby, thank you very much. Let's turn over to travel. Airbnb, as I say, giving lackluster guidance for the second straight quarter. On weak outlook ahead of the summer season. Will that save them? Alex Semenova. For now, the market is not happy. Good morning.
Good morning, Manus. Yet another instance this earnings season of a company beating on earnings but disappointing on guidance, and investors really punishing the stock for that. Shares of Airbnb are down about 6% this morning. That's the worst since October. This is even as it doubled net income from the year-ago period and beat on earnings per share for the quarter. That outlook, though, indicated that growth in travel is slowing ahead of the peak summer season. Airbnb projected revenue in the second quarter between $2.68 billion and $2.74 billion. Analysts on Wall Street had expected the higher end of that range. Evercore ISI said revenue and adjusted EBITDA were bright spots in the report, but revenue forecasts bracketed the street. And in its statement, Airbnb blamed the earlier timing of the Easter holiday this year, as well as currency headwinds for this disappointing outlook. Airbnb and its rivals, of course, have been trying to reach a new normal after the COVID-19 pandemic, but the recovery has been really choppy, with growth recovering in some regions while tapering off in others. Last week, Booking Holdings gave a worse than expected outlook, and Expedia Group disappointed on earnings as well. Manus.
Alex, thank you very much. Alex Semenova there. On fintech, Robinhood reporting a second straight quarterly profit as higher interest rates and cryptocurrency trading fueled the revenue growth. Katie Greifeld has the details.
Well, like you said, a second straight quarterly profit. Also, Robinhood beating and posting records on a number of different metrics. Let's go through some of the numbers right now. Net income for the first quarter, that totaled $157 million, or 18 cents a share. For context, analysts had been looking for 6 cents, so a big beat there. And you take a look at a year earlier, actually, that was a loss of $511 million, so a big turnaround there. When it comes to revenue, net revenue climbed 40% to $618 million, and cryptocurrencies revenues there surged 232% to $126 million. And when it comes to cryptocurrencies, remember, of course, earlier this week, you had Robinhood saying that they received a Wells notice from the SEC warning that the firm faces enforcement action over its crypto business. So a potential concern there, but you certainly don't see it in the stock this morning. Currently higher by about 8.5%. And going into these numbers, the stock had been higher by about 40% year to date. So really building on that momentum today, Manus.
Okay, Katie, thank you very much. Stock rocking and rolling there. On the consumer space, Tapestry cut its full year revenue outlook after sales decline in North America signaled weak demand. Isabel Lee has the latest on the retail narrative. Isabel, what's the story?
Hey, Matt, shares are edging lower by 3%. So Tapestry is the parent company of many brands we know, including Kate Spade, Coach, and Stuart Weitzman. And the company cut its revenue forecast and trimmed its full-year forecast to $6.6 billion. That's well below estimates. Revenue also fell more than expected, dragged down by sales from Kate Spade and Stuart Weitzman, which just really struggled to gain consumer traction, especially when it comes to their accessories line. We have revenue at Kate Spade falling 6% and revenue in Stuart Weitzman falling around 18%. Over at Coach, things are a little bit better because revenue is flat. Sales at the company, its average prices of handbags, which is a metric closely watched by investors because this is a revenue driver, was up. So at least there's that tinge of good news. But overall sales in North America and China are down. And for now, shares are really edging lower by 3%. Year to date, the stock has gained, though, around 5%, but still underperforming the S&P 500, Manus.
Isabel, thank you very much. Our next guest writes this. We're in the early stages of an earnings upcycle, and that will support global equities. And note double-digit EPS growth forecast for the U.S. equities this year and next. It is Jay Pelosky, CIO, co-founder of TPW. Jay, good to have you with me. Look, it's great to have that kind of an outlook, but if you miss or remotely miss, Intel, underwhelming, under the midpoint, Uber, underperforms, Starbucks, Airbnb, I mean, if you miss at all, there's severe penalties. Are you still as convicted on the earnings outlook after the sprinkling that we've had over the past 5-6 days?
Yeah, Manus, you make a good point, and great to be with you. And I think it's important to note that your point actually reaffirms the idea that we're not in some sort of bubble, right? We actually have a market that is discerning between winners and losers, and that's actually a good thing. And when you gross it up and look at the market as a whole, 81% of companies reporting to date have beaten estimates. That's much higher than normal. Usually that beat is around 70%. And even more importantly, if you look at the next 12 months earnings expectations, they are rising. And in fact, last week, you had the biggest jump in next 12-month earning forecast in the last 3 years. And so analysts listening to companies are guiding and raising their estimates higher. And so when you have earnings estimates going up and you have stock buybacks, by the way, running at about a 15% year-over-year increase, stocks are not going to go down.
I like what you say there, which is, you know, there's resilience. We're not in a bubble. The credit card spending, I'll come back to that in a moment. The Bank of America report, very, very strong consumer spending. So maybe it is in individual stocks we are becoming more discerning. But I love what you say about the Mag 7, and this is it. The penny dropped during several of the Mag 7 reports. Massive spending plans, roughly $45 billion apiece for Alphabet and Meta, and a strategy of spend like crazy now to monetize like crazy later. And it really does personify, you know, how Microsoft and Alphabet were rewarded. Meta asked for patience and they were lambasted. When you say that we're not in a bubble, how would you define where we are in Mag 7, which is a critically important part of the overall equity narrative?
Yeah, I mean, I think Mag 7 is pointing the way to kind of a winner-take-all, big moat type environment in the tech space. And so we're really focused, actually, though, Manus, on the idea that we're entering an age of investment, right? You look at those Mag 7 reports, they're talking about in spending, cap spending next year of 45 to 50 billion. AI is absolutely critical, right? Every country, every sovereign country needs their own AI. Yeah. Every AI requires lots of semiconductors. So we want to own what we call the picks and shovels in this space, and that's primarily in the digital space. That's the semiconductor stocks. And then, interestingly, and this is happening super fast. I've been in this business a long time, and the speed at which things are moving is just really incredible. And we're fusing the digital space with the physical space through the demand for power. And so we think we're setting up for shortages in things like copper, because we're expanding the digital space much more rapidly than you can possibly expand a physical copper mine. And so we want to own the picks and shovels in both the digital space, that's the semiconductor stocks, and in the physical space, and that's the miners. So copper miners, uranium miners, we think there's a tremendous opportunity. And so you mentioned credit card spending. We have fully employed consumers spending, driving consumption, and we have an age of investment fueled by cash-rich companies and governments who are ready and willing and understand the necessity to spend on things like AI and climate. And that is a very robust outlook for the global economy, underpinning our view that we're in the early stages of a multi-year blue sky period for the global economy.
I mean, that's not just Goldilocks on her own having a good hearty breakfast of a bowl of porridge. That is the whole world coming to feast. I want to dig into this. I'm a believer. You've sold it to me. I want to dig into this Bank of America report. They talk about consumer spending being at 1% year over year. This is in April. Take out some of the noise of Easter and one thing and another. That is following a rise of 0.3%. So we're on the extend and pretend. We're putting it on the old plastic. Lower income spending remains above higher income households. That's probably a classic. But this consumer is strong. Consumer is spending. But is there anything worrying in that, in that consumer spending on credit is rising? Is it the last breath of the consumer, or is it, don't worry, they've got jobs, they're being well paid, and you're being overly zealous, you're being overly negative on a read on this spike in credit card spending?
Yeah, I would take the former versus the latter. I think this is not really a big issue. Household net worth is off the charts, right? Record stock prices, record housing prices, fully employed consumers, real wages growing after inflation. You look at the Atlanta Fed nowcast for Q2, just came out yesterday, 4.2%, Manus. 4.2%. Consensus
pretty amazing.
For Q2 is 2%. Okay, so you're talking double. Now, we know that nowcast moves around very much, and we're not saying that's a set in stone number. What we are saying, though, is there's no sign that that there's going to be a massive round of layoffs, right? You have that demand side picking up. That's now driving through inventory restocking to the production side, the manufacturing side. And we wrote in our latest monthly, which you've quoted very generously, about a manufacturing revival on a global basis, actually using the same Bank of America source for that work. And so we're not concerned. The liabilities versus household net worth is actually at a very low number on a historical basis.
I would just give the qualification, just to make sure that I'm representing Bank of America fairly, is that the lower income households after-tax wages, which plays to what you said, salary growth has risen while the savings buffers remain. So even though we talk about the post-pandemic savings numbers dwindling, there's something different in these numbers. If I take that entire sweet spot that you've just painted for me, then maybe we're not restrictive enough and maybe we need a hike.
No, I think, look, the Fed took the hikes off the table, and that's the right approach. We're in a global rate cutting cycle.
We are.
You just saw the Bank of Sweden cut, so the G10, the big developed economies are starting to cut. That goes along with the emerging markets that are starting to cut. And it actually raises a key point for us, Manus, and that is we're starting to sniff out signs of a change in global equity leadership. And I'll just point out that ACWI ex-US, emerging markets, amazingly enough, and Europe have all hit new 52-week highs in the last week, while the S&P remains 1% to 2% below its 52-week high. And so we're watching the dollar very carefully here when you talk about rate cuts and rate hikes. We're watching the dollar very carefully. We think the dollar is ripe for a rollover, for a decline. And we think it could be like a momentum type decline, as you've seen in markets around the world, commodities, et cetera. And so if that is true, that would reinforce this idea that emerging markets led by China, of all places, is actually starting to pick up the baton and provide global equity leadership, which has not been the case, for more than a decade. That would be a major, major sea change for global investors.
Okay, preparing for that rotation. It's already happened, as you say, with Europe and with emerging markets. It's whether that accelerates. Jay, thank you so much for being with us this morning. Jay Pelosky of TPW Advisory. My guest this morning on the markets. We've talked about Airbnb. Are you booking? Will the earnings signal a slowdown in the consumer?
We're not feeling a lot of consumer pullback. I think our forecast is travel will be solid. As I said, just a slightly decelerating environment.
The conversation next on Bloomberg.
We're pretty pretty confident travel is going to remain strong. There may be some trades as consumers trade out certain things, but there's lots of ways to make their dollars go farther if they're focused, if they come to the right place. And so we feel really good about that positioning. And we're not feeling a lot of consumer pullback. I think our forecast is travel will be solid. As I said, just a slightly decelerating environment.
That's the view from the Expedia CEO, shrugging off the concerns about the consumer. This as Airbnb raise new red flags. Well, the company posted disappointing outlook, suggesting a slowdown in travel demand before the peak summer season. Is that what really is behind the story? Mandeep Singh is from Bloomberg Intelligence. Mandeep, the data in itself shows a little bit of a lull before the summer spike, but you would say it's possibly a little bit more about saturation and maturity of the product, is it?
I think so. And given, how big of a bump we saw with Airbnb during the pandemic, I mean, remember longer duration stays. People were staying more than a month, sometimes 6 months at Airbnbs during the pandemic. So they got that bump, in terms of their core room night book. And that is the metric that seems to be decelerating, even though they're doing a lot of things on the product side. I mean, Brian Chesky emphasized a number of new product initiatives, but nothing seems to be moving the needle at the scale where they're at. They may be actually close to 500 million room nights by next year. So that's a pretty big number when you think about, their category leadership position in alternative accommodations.
Tell me this, does it need AI to really move the dial? What is AI in Airbnb?
Well, so Brian talked about using an AI agent to book your travel. I mean, think of how we interact with the apps and websites. We go and punch in all the data, do our searches. What if there was a fancier way to engage with an AI agent that could do this?
I'd appreciate it. It would help me get through all the various filters a lot more quickly.
And so on the product side, they seem to be doing a lot of things. It's just it doesn't show up in that top line growth yet. And that's what market wants to see.
Yeah, the market is hungry for delivery on time. Mandeep, thank you very much. Mandeep Singh. Now, there's another stock that we're watching. It is Warner Brothers Discovery. The company reporting sales and profit that fell short of the expectations due to low TV ad sales and poor performance at the movies. Geeta Raghunathan is tracking this story. So Warner put it in a resilient front this morning. But Geeta, talk me through the background.
Yeah, so with Warner, Manus, this kind of really epitomizes everything that we're seeing in media right now. So you have the TV networks business, which brings in about 50% of the revenue. But remember, that's 85% of profits. And as you just said, TV advertising is in a very, very tough spot. We saw TV advertising decline about 11%. That caused about a 19% decline in EBITDA. The good thing, though, for Warner is that they are showing some good momentum in the streaming business. Remember, this is the storied HBO Max product. So they had some subscriber gains. They're showing some positive profits. And this is the new guideline metric that is kind of very, very important. So it looks like they can get to profitability there. The only problem is that the streaming progress is not going to be enough to offset the decline in the TV network business. And the other big thing that we're kind of watching for with Warner is this pending NBA deal negotiation. So they currently have a deal with the NBA. They're supposed to renew it, but they might lose it out to NBC. And that, again, kind of puts their TV network business in peril.
Yeah, that could be a flesh wound. Geeta, we'll track that story. Geeta Raghunathan there. Some sector price action for you before we go. Abby is with me side by side.
Yes, in fact, let's take a look at the sectors. We have the S&P 500 up slightly right now, up about 0.1%, but it is a broad-based gain, as small as it may be. Now, to the downside, on the other hand, we have some laggards, tech, but down just 0.2%. And the other three sectors that are lower also by very small amounts. To the upside, we have real estate, energy, healthcare, consumer staples. That real estate really doing quite well, up 1.5% on the morning. This as yields are a bit mixed, so it gives a little bit of a reprieve to those dividends. Now let's take a look at another dividend-rich sector. That is the utility sector. Right now on pace for a 7th up day in a row, the longest winning streak just since April 25th, and that's because this stock or this sector over the last 4 weeks higher. This is the first 4-week winning streak for the utilities index, Manus, going all the way back to 2022. Now, some see this as a defensive move because it is a defensive sector, especially given the fact that you have it rising as yields are rising. That is an interesting message. Typically, these stocks would not do better as yields rise because those dividends look less well. So again, some are saying that this is maybe some sort of a defensive shot across the bow of some weakness ahead. But on the week, I believe we have the S&P 500 higher. So an interesting mixed message there.
Abby, thank you very much. Coming up the show, we'll set your watch for you, your trading diary. Up next on Bloomberg. Jobless claims pop a little bit higher. Was it an anomaly or something more malevolent? Either way, yields drop. We're off the lows of the day. Stocks are struggling. Narratives from companies like Airbnb. Is that really about saturation? Right now, NASDAQ down by 0.2%. So we're treading water. We've got a pretty sizable auction coming through on the 30-year government bonds. We've got $25 billion worth of government bonds coming through. This is how the rest of your week looks like. San Francisco, Fed's head Mary Daly led it today, plus more bond sales, as I say, this afternoon. Rolling through to the University of Michigan consumer sentiment, that is tomorrow. Fed speak from Bowman, Goolsbee and Barr. And finally, the monthly U.S. federal budget. That was countdown to the open. The rest of the team will take you through your trading day. From New York, a very good morning.